welcome to the lecture on Introduction to Bonds. So, we will discuss about the bonds in this class, and they are one of the major securities that are traded in the capital market. So, coming to the definition of bond is a long term investment instrument usually issued and sold by big businesses or governments even to lenders for raising large amounts of capital. So, they will be issuing that a bond and selling that these documents, and they will be raising the large amount of capital when they need it for starting certain undertaking or some business or so. So, that is issued and sold by these business groups, large groups. Now, they are also the written promises by the borrower to the lender to pay. So, once they are taking the bond, then certainly there are certain conditions, and these are like what they will be paid is the redemption value and a fixed set of cash payoffs throughout the maturity period using interest rate called the bond rate. So, whenever there is issue of bond, so there is a bond rate attached to it or defined to it. So, based on the bond rate, he will be getting certain amount at frequent intervals or at periodic intervals, that is basically defined, and that we will discuss. And also the redemption value, that is in the end he will be getting the amount also. So, in between he will be getting certain cash payoffs throughout that maturity period using the interest rate, that is called bond rate, and also its redemption value. And and then the maturity period, this maturity period is normally 10 years or more. So, that will be the maturity period for which he will be given the cash payoffs. And then normally it is divided into semi-annual payments. So, if suppose you have a 10% of interest rate, and if 1000 is the value, so in that case he will be getting 100 rupees every year, and in that if it is a semi-annual payment, then 50 rupees every 6 months will be paid. So, that will be paid on certain days called the payment days or the coupon days. So, that is how you have the definition of bond, and in that normally you have the amount which is full amount which is borrowed, that is known as the redemption value. And also there are rates like bond rate or coupon rate, these are or contract rate, these are the synonymous terms which will come when we discuss these terminologies. Now, coming to the bond valuation, how the bond is valued, how the value of the bond is calculated. So, the investor receives interest payments throughout the maturity period and receives the principal back on the redemption date. So, we already discussed that he will be getting the interest payments throughout the maturity period. So, you have a period that is maturity period, and throughout that he will be whoever is investing, that is investor, he will be getting certain payment, and in the end on the redemption date he will be getting the principal amount also. Now, value of the bond at the time of purchase is assessed as the present value of the future payments of interest plus the present value of the redemption amount. So, it's clear that if something its value is to be seen. So, the value of bond will be like whatever he is being paid in future. So, he will be getting that amount after frequent some fixed intervals. So, all those payments present worth or present value will be calculated, including also that of the redemption amount, and that value will be the bond value. So, all cash flow of the bond, including the redemption value plus all the interest payments, are brought back in time from the future to the present to form the discounted value in the current time. So, that is how we are getting their value, because we are getting its discounted values in the first. So, if it will be divided by 1 plus interest rate, then in the second 1 by 1 plus interest rate raised to the power 2, like that. So, we are getting the discounted value every time, and then we are getting the value of the bond. So, suppose for example, if you have suppose you have a bond, and suppose you are talking about the rupees 1000 bond, and now the thing is that that is known as a par value. So, this is known as par value of the bond, and suppose the maturity time is 10 years. So, if the maturity time is 4 years, and if suppose the bond rate is 8%. So, and by convention, if you get the semi-annual payments. So, in that case, as we know that bond rate is 8%. So, this person will get the interest at the rate of 8% of 1000. So, your interest will be rupees 80. So, the annual interest, that will be 0.08 multiplied by 1000. So, that will be 80. So, semi-annual payment will be 40 each. Now, what will happen that this 40 he will be getting for the 10 years, and at 6 months of period, at 6 month of gap, and in the last 20th installment. So, there will be 20 installments, and in the 20th installment he will also be getting this value also. This is 1000. So, that is original amount which is borrowed. So, that 1000 will also be there. So, in that case the bond value will be calculated. So, that will be nothing but you have 40 getting, that is 1 by 1 plus 0.04. So, that is your 4% interest for every 6 month. So, similarly you have 40, then you have 1 by 1 plus 0.04 raised to the power 2. So, this way will go, and you will go in the end you will have the 20th payment. So, that will be 10th year. Here you will be getting its 1 by 1 plus 0.04 raised to the power 20, and then apart from that you are also getting the amount, original amount borrowed. So, that will be your 1000. So, this will be 1000, and it will also be having the multiplied with the factor 1 by 1 plus 0.04 raised to the power 20. So, if you take this, if you do the calculation, you will be having the calculation this as suppose 38.462, and then another you have 36.98 or so, it will be moving, and ultimately for this amount it will be 474.64. So, you will have all these amount which is decreasing basically, because you are multiplying with the factor 1 by 1 plus r, that is if the r is the bound rate, and then every time as the time is progressing the amount is same. So, its contribution will be getting less and less. So, this will be coming out to be 1000. So, this is how that you see that how all these cash flows which is there including the redemption value. So, all their worth, when they are brought back, their worth is brought back to the present value, then it is coming and equal to be 0. So, that is coming as 1000. So, that is how this bound value is calculated. Now, what happens that many a times the value of the bound turned out to be less than or less than before when using a higher rate of return. Now, what happens that when we look at some other investment opportunities and we see that and we try to calculate based on the different rate of return, that is current rate on which the you will have that rate differing from the bond rate, whether that rate may be larger or that may be the smaller than the bond rate, then this value turns out to be either less or more than this its par value. So, that basically is because of the market rate of return for similar securities. Many a times we feel that this rate may be different than the bond rate, that may be larger or the smaller. So, in that case, if you have to calculate this value of the bond, that is of 8% coupon rate, but then by discounting the previous cash flow of the yield at 10%, in that case what will happen to this bound rate. So, suppose in that case if you have the yield rate of, if you are thinking of yield rate of 10%, in that case your B0, if you try to find, you have to you have the so 10% means semi-annual, it is 5%. So, it will be 1 by 1 plus 0.05. Then you have again 40 into 1 by 1 plus 0.05 raised to the power 2. So, that way it will go, and in the end you will have again 1000 and 1 by 1 plus 0.05 and raised to the power 20. So, suppose in that case when this market rate is higher, you are taking that current rate as the higher one. In that case, if you calculate this B naught, then its value is coming as 875.38. Now, what you see that this value of the bound that is turned out to be less. So, when you are using the higher rate of return, when you are comparing with that, when you are using the higher rate of return, in that case the value of the bond is turning out to be less. So, that is why it is written that value of the bond turned out to be less than before when using a higher rate of return. Similarly, if you take the rate of return as the smaller one, in that case the value will be more. So, this way the value basically changes, and we know that we use the same formula when we have the I. So, we will take that V naught and it will be summation of 1 by 1 plus I raised to the power t, and t will be varying from 1 to n, and plus your the redemption value, and that multiplied by again 1 by 1 plus I raised to the power n. So, that way we will be calculating, and we will be seeing that it may be either more or less. So, that much so when the required yield is larger or smaller than the bond rate, then value or purchase price is lower or higher than the face value of the bond. Now, how we can see from the example. So, suppose there is an example that you have a rupees 1000 bond, and suppose it is maturity time is 15 years, and semi-annual coupon is there, and this semi-annual coupon is at 9.5%. Now, in that case you have to find the purchase price. So, to find purchase price that yields, so that will be yielding like 11%. So, in that case your bond rate is 9.5%, and the current rate that yields basically is 11%. So, in that case what will be the purchase price? So, you can find this by using this I value as 11%, and in that case you will do the same thing. You have the semi-annual payment will be on the basis of 9.5%. So, you will have 95. So, 47.50 will be multiplied with. So, your B naught which you will be calculating. Now, B naught will be basically calculated. So, you will have the summation of and you will be doing that with 1 by 1 plus I. So, that will be 0.055, and this raised to the power t, and t will be varying from 1 to 30. So, because this is your semi-annual payment and it is going for 30 years. So, you will be doing that, and this will be multiplied with it is 9.5%. So, if you calculate semi-annual payment, it will be 1000 into 0.095 and divided by 2. So, it will be 47.50. So, you are going to multiply that with 47.50, and then further you have this as the 1000 bound. So, this is 1000 and again multiplied by 1 plus 0.055 and raised to the power t. So, this n is 30. So, this is 30. So, this way this will be coming out to be 0.006, and if you calculate these sum, then this is coming out to be 14.534. So, you will be getting something like 890.96. So, what you see that in these cases this purchase price will be coming out to be 890.96. That is what that when your this rate is higher, market rate is yield that is at higher percentage. In that case the B naught value is decreasing from 1000. Similarly, if you have the rate is smaller, in that case the B naught value will be larger. So, and its example can be seen like suppose you have the rupees 2000 bound, and here you have a maturity of you say 10 years, and your bond rate is or coupon rate is 12.25%. Coupon rate is 12 1/4%, and in this case you have to find the current value. So, you have to find current value, and the condition is that the investor wants yield at 10%. So, investor wants yield to be 10%. So, in that case if you again you can do the same thing. You have coupon rate is 12 1/4%. So, again in this case if we take the semi-annual payment, in that case it will be 122.5. So, and in this case since it is not mentioned that there will be semi-annual payment. So, we have to take the annual payment itself. So, your coupon rate will be 12.25%. So, you will have a 120.50. So, if you calculate the V naught, it will be 122.50, and then you have to find the summation of 1 by 1 plus I. So, 1 by 1.1 raised to the power t, and t will be going from 1 to 10. So, it is maturity time is 10 years, and then again we are going to have the 2000 multiplied by 1 by 1.1 raised to the power 10. So, that will be 0.3769, and this factor is 12.462. So, if this value is coming out to be 12.462 and this is 0.3760. So, taking these two values, you see that it is 2280.40. So, what you see that these values, they are coming in one case, it is smaller. So, when your interest yield rate is 11%, it is more than the bond rate. In that case, the value is less than the face value, and otherwise it is more than that. So, that is what it is written, that when the required yield is larger than the bond rate, the value or purchase price is lower. So, when the required yield is larger, in this case it is larger, your the value which is less than the face value, and when it is more in the next case, in that case it is the yield rate is yielding is the percentage which we want, the yield is smaller than the bond rate. In that case, the value is more than the face value of the bond. Now, how we define it? That we define it like this, that when you are if a bond is at lower bond rate, and if it is sold for some smaller amount to yield higher return. So, if it will be sold for a smaller amount to yield that higher return, in that case it is said to be sold at discount, and the discount amount is the difference between the face value and the purchase price. So, in that case, basically when you are using the higher yielding return, then in that case what we see, that value is becoming smaller. So, the difference between the face value and the purchase value, that is known as the discounted amount. Now, contrary to that, if your bond at higher, you have by higher bond rate, and you are selling at larger amount to yield higher lower return basically. So, in that case it is to be it is said that it is said to be sold at premium, and premium amount will be difference. So, in this case your difference will be there between the purchase price and the face value. So, in the purchase price will be more. So, the difference of purchase price and the face value, that will be known as the premium amount in such cases. So, this discounted concept and the premium concept will be used in our further studies. So, what we have seen that your bond is when it is you have the case of premium as well as the discount amounts, and discount is the present value of the differences in interest throughout the entire maturity period, and it must be subtracted from the par value to form the current value or purchase price of the bond. So, before that what we wish to see, what we saw that in this case your bond value was 1000, and then ultimately this is the amount. So, this is a face value of 1000, and the bond value is coming out to be 890.96, and so this in this case this is the discount which is offered, and so discount amount, if you calculate, this discount will be 1000 minus 890.96. So, 109.04 this will be your discount in such cases. Now, similarly when you are you have the 2000 bond, and it is sold for 2280. So, you have 2000 bond and you are selling for 2280.40. So, that it gives you 10% yield, which is less than the bond rate. Bond rate was 12.5, but you are selling at 2280. So, that the yield is 10%, now less than the bond rate. So, in that case this difference of 280.40. So, this premium amount which will be 280.40. So, this is known as the premium, that is what it is defined as. Now, when we tell that so that is what we are talking, that when we talk about this discount, now this discount is nothing but it is the present value of the differences in interest throughout the entire maturity period, and it must be subtracted from the par value. So, that we can further understand, like you have seen that you had the bond value of 1000, and if you are taking for this 9.5% interest. So, you will have semi annual interest, that is 1000 into 0.095 and divided by 2. So, that is your 47.50. This is your semi annual interest based on 9.5%, that is based on 9.5%. Now, if what happens that if you take the semi annual interest based on 11%, in that case semi annual interest based on 11% will be 0.11 by 2. So, this will be 55. So, what happens that this difference, so this will be your semi annual interest based on this is 11%. Now, what you see that the difference of this interest, that is your difference of interest per term. So, it will be 55 minus 47.50. So, basically this difference is for the entire maturity period, and you have 30 terms. So, if you find the value of these, so this is your 7.50, and if you take the its value at present, this 7.50. So, that will be multiplied with the factor, that is summation of 1 by 1 plus I raised to the power t, and that will be at 11%. So, that basically will give you this 109.50 or 04, 109.04. that is what was the discounted amount. So, you had this discounted amount of 109.04, and if you calculate this 7.50, and if it is multiplied with summation of 1 by 1 plus 0.1, and that is by t, and t will be 1 to 30. So, this will be 0.055 basically it will be, because it is semi annual payment. So, 1 plus 1 0.055, and then if you take this value, now this will be basically 14.53. So, that comes out to be 109.04. This is what was your discount. So, what you see, you can come to this, that the discount is the present value of the difference in interest throughout the entire maturity period. So, it is the difference what we calculated the interest, that is calculated first, that is coming out to be 7.50, and it must be subtracted from the par value to form the current value or purchase price of the bond. So, this is for the discount. Similarly, you have the bond also for the premium also, and premium will be defined as, the premium is the present value of the difference of interest throughout the maturity period of 20 terms, and in this case basically it is added. So, if you take the example of premium, So, in the case of premium, what we have seen that you had the 2000 rupees of premium. So, it is a bond, and here you had 0.1225% was there. So, the 12.25% was the bond rate. So, semi-annual payment was so semi-annual interest was coming out as 122.50. So, this is semi-annual interest, and this is for 12.25%. Similarly, you have at the rate of so this is basically you have yield rate is 10% only. So, for 10% it will be 100. So, this is semi-annual interest at 10%. So, that is your yield rate. Now, in this case the difference of interest is coming out to be 22.50, and this 22.50 this if you calculate its again its value and multiplying with the factor. So, that will be so if you multiply this 22.50 with that factor, that is summation of T1 to and you have 20 terms, this is 10 years. So, you will have 20 terms 1 by 1 plus, and your this yield rate is 0.1. So, if you take that and on that T, so this if you take it will be, this is coming out to be 12.462. So, this is coming out to be 280, this is 280.40, that is your premium. So, this way we can define the premium is the present value of the difference in interest throughout the maturity period of 20 terms, and in fact what you do is that you are adding value to the this face value to form the purchase price of the pound. So, purchase price in one case was less, and in another case it was more, and in a nutshell what we see that bond is sold at a value less than its par value when the required rate of return is greater than the rate stated on the bond. So, that is case of discount, and when you are selling the value higher than its face value, then it is a case of so that is the case of a premium, selling at premium. So, these are the two cases in which these bonds are basically evaluated, and their value is calculated. So, this is about the premium and discount prices related to the bond valuation, and that is how we calculate, and it will be used, this concept will be used in our studies related to the bond valuation and other topics that we will come across. Thank you very much.